Trading is not easy. A lot of people who do try it are not profitable in the long run. Now, whether you're in the same boat now, have found some success, or are in a cycle of bouncing between feeling pre-rich or pre-broke, we know that the challenges people face when it comes to trading are often incredibly similar. Things like struggling with consistency, emotions, and more. From listening to all successful traders though, we know one thing. You need a plan. And no, winging it or having no strategy is not a plan. But how do you make one? Well, in this video, we will cover some of the key fundamentals of developing your own trading plan. And hopefully after this video, you'll stick to it before taking your next trade. The first thing you should consider when developing your own trading plan is your trading style. While there are many names for all the different styles out there, traders can all generally be categorized into two: swing traders and scalpers. So swing traders typically hold positions anywhere from a few days to a few weeks and sometimes even months. Scalpers or day traders are much more short-term focused, typically never holding positions overnight, with most trades lasting from a few minutes 2 hours at most. So to find the best one for you, first consider how much time you have to dedicate to trading. For example, do you work a full-time job with a 9-to-5 schedule? Well, if so, you'll likely do better at swing trading, as you don't have to watch the market as frequently in a workday. The next thing to consider is your psychological makeup, and this will require you to look inward and understand yourself. So are you patient or are you impatient? Are you comfortable with letting things play out, or do you have a need to keep a close eye on things? You need to really understand what makes you tick as a person, and that will help you guide to make a decision on whether to swing trade or scalp. Now, you can do both, but the trading styles are essentially at opposite ends of the spectrum, with different challenges that require very different skills to do well. In scalping, you have to be quick at making decisions under pressure, maintaining a high level of focus while watching charts for hours at a time. On the other hand, swing trading will require you to be much more patient, as setups will show up more infrequently. You'll need to be good at stepping away from charts and sitting on your hands. Ideally, you pick one, you stick with it for some time and get good at it before exploring the other side of things. After you picked your trading style, you should have a sound risk management plan. First, you'll have to identify your risk tolerance, which can be a very personal thing. Risk tolerance can be thought of as how much you're willing to lose on each trade. So ask yourself, am I comfortable losing this amount of money on a trade? Now, depending on your answer, you'll find yourself either being more risk-loving or risk averse. The size of your trading account is also an important consideration as well. If the account is too small, you might be tempted to over leverage and trade much more frequently than you actually should. If it's too big, you might become more fearful and struggle to follow through with your trading plan. So as a rule of thumb, the ideal account size should be an amount that is big enough to be meaningful to you, while still leaving yourself ample savings and an emergency fund. Another rule of thumb is that when you're new and you're still learning, you should risk no more than 1% of your total trading capital, and you should only increase your size after a good period of profitability. It's also important to keep the context of trading styles in mind here. For example, if you scalp and you take about 2 to 3 trades in one day, no matter how risk-loving you are, risking more than 1% on each trade will be too much, because a bad week could easily wipe you out due to the higher trade frequency that scalping involves. Now, on the flip side, if you're a risk-loving swing trader who only takes 1 to 2 trades a month and aims to capture those big multi-week moves, risking just 1% on each trade might not make the most sense. So risk management is key to ensure you survive losses that will inevitably come from trading, and also keep you in the game even when you're facing a drawdown. Instead of focusing on making profits, risk management is all about sticking to your set risk levels, using reasonable stop loss levels, and keeping the profits that you make. Another key part of your trading plan will be your trading strategy. Type trading strategy on Google or YouTube and you will see a million results covering different trading strategies, some very simple, some that are a lot more complex. But whatever strategy that you choose, make sure that it has clear rules for you to follow, like your entry criteria, stop loss levels, and take profit levels. For example, let's say that you're using a one-day trend following the strategy with the 20-week simple moving average and the 21-week exponential moving average. The entry criteria could have two rules. First, the 21-week EMA must be above the 20-week SMA. You'd enter a long position when the price retests the moving averages and closes above both. Then the rules for your stop loss and take profit levels could be stop loss to be placed at the last low, take profit level at 2 times the distance of stop loss from entry. Now, in case some of the terms that I mentioned sounded like gibberish to you, worry not, a quick search on the internet will get you up to speed. The key here is having clear rules for identifying trade setups, setting stop losses and take profit levels to maintain consistency in your trading over the long run. Now, after picking a strategy, you will need to backtest it before using it on a live account. While past performance doesn't guarantee future results, proving a strategy has at least worked in the past helps to avoid bleeding money unnecessarily if it turns out to be bunk. Besides, it serves as practice to follow the rules of the strategy over weeks or months of historical price data, and it helps you see how the strategy performs in various market conditions, like consolidations, downtrends, and uptrends. So, how far back do you need to go to start your backtest? Well, the answer to this will depend on the trading style of your strategy. If you're scalping the 5-minute chart, you might only need to go back up to a month or 3 if you trade slightly longer intraday moves. However, a swing trader may have to go back about 6 to 12 months as they trade on a higher time frame. A way to backtest a strategy is by using the bar replay feature on TradingView. This tool lets you go back in time and replay historical data candle by candle, or even fast forward through larger time periods. Also, make sure that you have a spreadsheet on the side to record the wins and losses of your trade so that you can track the performance of the strategy that you're testing. It's important to note, however, that backtesting cannot replicate the IRL process of trading, such as having skin in the game, patiently waiting for a trade opportunity, and the emotions that arise from being in a trade in real time. After creating a trading plan, it is your duty to stick to it. If you're impulsive and abandon your plan, you're essentially gambling. Good traders are those that approach markets with consistency and discipline. And one thing that helps traders stay on track is by monitoring their performance. The way to do this is by keeping a trading journal. Good trade journaling involves keeping a detailed record of trade entries, sizing, wins, losses, as well as a reason for entering and exiting a trade. This practice helps you review your past trades and find patterns, what they're doing right, things to improve on, and learn from mistakes, especially the emotional ones. To start journaling your trades, you can find free templates for Excel or Google Sheets online to help you organize your trade data, or you can also use trade journaling software such as CoinMarketManager, which automates parts of your journaling process. Treat your trade journal like a diary and be diligent in recording your trades. This very simple habit can be very impactful in helping you stay on track and even remind you that trading is serious business and it's not just clicking buttons on a screen. Well, that's it for this guide on creating your own trading plan. There are a few other considerations that we didn't cover, such as selecting the markets that you'd like to trade, creating a routine and schedule around your trading, and more. Hopefully, though, this video has provided you some pointers on the most important aspects of creating a good trading plan. If this video helped you out, make sure to leave us a like, subscribe for more future content, and if there's anything else about formulating a trading plan that you want to know about, let us know in the comments below, and I'll see you in the next video. Bye.